You're listening to the Option Alpha podcast from optionalpha.com, where we show you how to make smarter trades, learn how the stock market really works, and generate consistent monthly income. Now, your host and head trader at optionalpha.com, Kirk Duplessis.
Hey everyone, this is Kirk here again at optionalpha.com, working every single week to make this the most popular investing podcast offered in iTunes and online because it's based on one thing and one thing only, and that's helping you make smarter trades. So thank you so much again for tuning in today. And I know a lot of people have actually been waiting for this episode to come out because today in show 53, we are going to tell you the one strategy that if you just use it 1 hour per month actually outperforms the S&P 500 by 24%. And I know right on the outside that seems really crazy because last week we debunked the whole myth around robo-advisors. And if you haven't listened to that episode, that's episode 52. It's right before this one. And we basically showed you that all of these robo-advisors, which are gaining in popularity, don't actually beat the benchmark index, which is the S&P 500. Now, in today's show, we're going to show you, again, how just using one simple option strategy with literally less than 1 hour per month, you can actually outperform the market or generate what's called alpha. Now, a lot of people ask, well, why isn't everybody doing this? That's my mission, right? Is to get this thing out here so that a lot more people know about it. In fact, I would again ask you that if you think that this episode is helpful in any way or valuable in any way, please send it to somebody else that you know. Send it to one friend, one family member, maybe your financial advisor, because financial advisors need to be doing this and they're not doing it enough, and help spread the word about what we're trying to do here, because the reality is that not a lot of people are doing this at all. The fraction of people who are trading options is incredibly small compared to the people who trade stocks. And the reality is that options gives you a much better opportunity to generate excess return or alpha above the market benchmark and do it with lower volatility in your account, meaning lower swings in your account balance. So in today's episode, we're going to do a couple things. And first, we're going to go through kind of like, what is this strategy? Why does it take an hour? Then we're going to talk about performance, how it's measured. We're going to talk about the one strategy that I've been alluding to this entire time and kind of break it down start to finish. And then we're going to get into a lot of the metrics and numbers and basically how you can use this strategy in your own trading. And plus, I've got a little bonus strategy that I also want to talk about too, because it also outperformed the benchmark index. And then you can choose between which one you want to do. If you want to do strategy A or strategy B, it doesn't really matter, but both outperform the market. So first, we want to start with why an hour? Why do I say an hour? And it's not because I say, hey, look, it's a 1 hour strategy and it's a really cool, catchy title, obviously. So obviously a lot of people are probably listening. Maybe you're listening to it too, because you heard me say that it's a 1 hour strategy. But I honestly think it actually takes less than an hour. I was being incredibly generous by saying that it takes an hour per month to do this. I think the reality is it could take less time to do this strategy than it takes you to post a status update on Facebook or Twitter. And we all know that everyone's checking hours and hours per day on their status updates. Why not take 1 stinking hour of your time to do something that actually generates more money for your portfolio than just blindly investing? The reality is that I truly believe that you work too dang hard for your money. I know I do. I work really hard for my money. So why not invest in yourself just an hour? And again, the hours assuming that you've got dial-up connection, right? Like old school internet. It takes you forever to type in your password. Then you've got to log in and do all this stuff. But the reality is you can do it on your mobile phone in probably 5 minutes and you're done. Less time than it takes to post a Facebook status update or watch a funny cat video online, right? So the reality is, let's take this time to actually understand how to do it and execute it every single month. So the next thing we need to talk about is how was performance measured? Now, somebody had a great follow-up to our last show in the show notes on show 52, which is, okay, performance is one thing. So if you beat the market by 24%, which is what this index did or what this strategy did, if you beat the market by 24%, that's great. But did you also have a lot of volatility? So it's a good question because what you don't want is you don't want to beat the market, but then have a substantial amount of volatility or standard deviation or movement in your account to get there. Meaning that if my opportunity to make 10% now turns into an opportunity to make 15%, but I took 10 times more risk, then maybe that risk to reward ratio doesn't make sense, right? If I could lose 50% tomorrow to make an extra 5%, does that really make sense? And so the way that we looked at it, obviously, and the way you should start looking at things too, is ask yourself, how's the return and what is the volatility, or what is the standard deviation? What's the movement in the account? So let's get into it now and let's talk about this one strategy. This one strategy that you can use that's literally less than an hour per month is simply, drumroll please, a covered call. And it's not just any covered call, because I want to point you in the direction of the CBOE benchmark index, which is the covered call at the 30 delta. See, now what they did is they put together this benchmark index of different option strategies. And of course, I'll link out to all of this stuff in our show notes page at optionalpha.com/show53. But they put together this benchmark index that said, okay, if you did this strategy, what would your performance be against the S&P 500? Or if you did that strategy or X strategy or whatever the case is. And this is actually something, just a little sidebar, that we're testing here at Option Alpha, but on a much larger scale. They tested maybe about 10 to 15 different strategies, but now we're taking it an extra degree by testing out every little inner iteration and variation between that, versus what they did is just very benchmark and standard. But again, it kind of proves the point for what we're trying to do here. But the one strategy is, again, a simple covered call. And so what a covered call is, for those of you who are new to options trading, is you're simply getting into a position in stock and then you're selling a call option against that position. And by selling a call option against that position, you take in a credit, or you take in that premium in exchange for forfeiting your potential upside beyond your strike price. So for example, let's say that a stock is trading at $100. You would buy the stock at $100. And now that you have that stock position, you have the ability to sell a covered call on it without any additional capital out of your account. So it doesn't cost you any money. Let's say that the 105 strike price call option is trading for 50 cents. So you could sell that 105 call option for 50 cents or $50 in notional value, and you get to collect that money. It comes right into your account. Now, since you sold the 105 call strike, that means that you forfeit your right to make any money above 105. And so in exchange for doing that, you also collect this 50-cent premium, which reduces the cost of owning the stock by 50 cents. So now the cost of actually owning the stock was the $100 that you outlaid less the 50-cent premium, which is $99.50. Okay, so you can see how this concept works in general terms, is that when you reduce your upside potential, you get paid to do that, and that reduces the cost of ownership of the stock, therefore increasing the probability that you make money. Because now if the stock stays right exactly where it is at 100, you actually make money. You make $50 because the stock never went higher than 105, but it never went lower than your break-even price, which is $99.50. So now you can start to see how this reduces the cost of ownership and it increases your potential probability for success. Again, why more people don't do just this one strategy is beyond me, but this is the point of what we're doing here at Option Alpha. So the CBOE, again, put together all these different benchmark indexes. And one of the benchmark indexes that they put together was called the Buy Right Index on the 30-day Delta. And what it basically said is that every month, what you would do is you would own the S&P 500 via a benchmark index like SPY or whatever you want to use. You would own the S&P 500, no different than just buying the benchmark index. And then every month you would sell an out-of-the-money call option at the 30 delta. So again, one time per month, you would sell a 30 delta call option against your position. And what they did is they went back all the way to 1986 and tracked the performance of selling this covered call religiously every single month, good, bad, or indifferent. If you made money, if you lost money, if the market went higher than your strike price or never got there, or whatever the case is, it tracked all of that going back to 1986. So it's almost 30 years of data that they have that show the performance of this simple covered call strategy. Again, it takes less than an hour of your time every single month against the benchmark index. Now we know, again, from last show, that the benchmark index is the one that we should be basing everything off of. And Wealthfront and all these other guys, they don't even meet the benchmark index. Now, over that time period, what we found, or what they found, is that the S&P 500 returned $1,598 for every $100 invested. Okay, so at 1986, they started both at $100 invested, okay, and it's just to show the return and the variance and stuff like that. Doesn't necessarily mean you could have bought the market at for $100, but they started each strategy at $100. The S&P 500 returned at the end of that period $1,599. The covered call, the 30 Delta Buy Right Index, returned $1,985 for every $100 invested. So a 24% difference in the return of the benchmark index versus the simple, very vanilla, very plain, incredibly stupid simple to do every single month covered call strategy. Now there you have it, folks. Right there, plain and simple, black and white, options trading, when used appropriately and effectively, can enhance your portfolio returns. I don't know how else to say it. I'm like throwing my hands up here right now recording this podcast because that is the end all be all. Everyone always asks, how does options trading enhance your returns? How does it beat the market? That's how it does it, by selling option premium, by collecting that money into your account, reducing the cost of ownership, and increasing your potential probability for success. Now, what I think is really, really cool that came out of this report here is the volatility or the annualized standard deviation of an option selling strategy like this one versus the market. So when you actually go back over this time period, again, which is almost 30 years, then you look at the S&P 500 and the standard deviation or the variance and volatility in the S&P 500 was about 15.3%. Okay, that's kind of like the average 68% range. When you look at what the buy right index or this covered call strategy was 13.2. So not only did you outperform the market on a return basis, you generated more money for your portfolio, but your variance in doing so, meaning the volatility in your account, was dramatically less over that period. Okay. And there's some other strategies in here that we'll link up in here that had even lower standard deviations, but, didn't generate as much money. So obviously there is a trade-off between, no variance and obviously not generating any money in your account. But that's one of the key things, is that this option selling strategy not only just generated more money, but it was low volatility in your account, lower swings in your account balance than you would typically have. Now, most people would say at this point, they would say, hey, Kirk, that makes sense, but a covered call isn't really going to work well when the market's going higher, right? So when we're in a huge bullish market and a huge bullish move, a covered call is really not going to work too well. Well, that's not the case at all. If you actually look at the data, again, link up, it's all in the show notes at optionalpha.com/show53. What you see is that in every single cyclical bull market that we've been in, that's going from the dot-coms to the 05, 06 kind of range before the real estate crash to even the time period that we're in now, where we've had a massive run up from the bottom in 2008. Every single time, the covered call strategy had outperformed during the bull market. That means that the stock market does not even outperform this strategy when it's in a full-blown bull market mode, which is what most people would assume. What most people blindly assume is that stocks outperform a strategy, even like a covered call, during this time period, but it's not the case. And of course, as the market drops, then this strategy outperformed the market, because as volatility expands, it means you collect more premium. It means you get further away from the money with your deltas and your options. And so even during these market crashes, this covered call strategy, just on a very simple basis, outperformed the market. Now, before we get kind of towards the end here, and I want to kind of wrap up with some different points, I want to also tell you about another strategy that outperformed the market as well. It didn't do as well as the covered call, mainly probably because of some of the market volatility in 2008 and 2009. But the other strategy that outperformed the market was the CBOE put right index. Now, this strategy went out and just plainly sold a put option on the S&P 500. And at the same time, they purchased some treasury bills, since you had the additional cash after selling kind of this cash secured put index. So a little bit less capital required to do this, but it basically creates almost the exact same payoff diagram as the buy right index. Very slight differentiation between the two, but the payoff diagram is exactly the same as the covered call or the buy right index. And what they actually found is that, again, going back all the way to 1986, and tracking just a single naked put option on the market generated a total of $1,722 for every $100 invested. Again, $1,722 compared to the $1,599 that was generated with the S&P 500. Again, volatility in the account was dramatically less. And you would think on the outside that volatility with a naked put option would be really, really risky, right? Because nobody wants to sell a naked put option, right? You start talking about naked options, God forbid you start talking about naked put options and market crashes and all this other stuff. And people always go crazy about the fact that there's, this huge amount of risk. But when you actually did this strategy, when you actually tested, instead of theoretically just assuming that it didn't work, what you found is that the annual standard deviation with just the put right index, or just a naked put, was 10.2% per year. Now, this is actually incredibly less than the covered call index, which is 13.2, and obviously almost 5% less than the S&P 500, which was 15.3. So again, we're trying to bust these myths here that selling naked options, especially selling a naked put option, which everyone thinks is incredibly, incredibly risky, actually had a better performance than the market with dramatically less volatility. And why is that? And that's because that even during those down periods, like in 2008 and right after the dot-com bubble, even during those massive downward moves in the market, volatility in the options market increased exponentially. I mean, in 2008, we saw the VIX go upwards of 80, right? And right now it's sitting at like 15. And so when volatility increases like this, it means that selling that put option generates even more cash, sometimes 8 or 10 times more cash than it would in a bull market. And so what that means is that you are compensated so much for selling options even during a down move that overall it evened out and leveled out your returns over time. So you had dramatically less volatility in your account and you outperformed the market. Okay, so as we kind of wrap up here, again, the whole point in doing this and the whole reason that we're here doing Option Alpha, the whole reason I do this all the time is because I hate when people say you can't make more money than the market. I hate when I hear it on the news. I hate when I talk to people at, barbecues and at whatever, like family events, and everyone says, well, you can't beat the market. Yes, you can. I'm like slamming my desk here. Yes, you can. And we just proved it in today's podcast because two simple strategies, a simple covered call and a simple naked put option, beat the market with less volatility. Hands down, end of story, end of discussion. If you're not using options in your account right now, you are trailing everybody else who is. And again, these strategies take 1 hour per month to do. So skip one Facebook status update, skip one Twitter post, stop scrolling through Pinterest, stop looking at playing Angry Birds on your phone. Take 1 hour of your time and learn how to do a simple option strategy in your account. Now, obviously, you can start getting even more advanced and complex and start to do strangles and straddles and all this other stuff, which does even better in your account, and start learning how volatility works and how to manage trades and how to increase your win rate. And all of that stuff we teach you for free at Option Alpha. You don't have to pay to learn any of that stuff. It's all free. It's always open and available. But learn something simple like this. Again, try to send this to one person that you know that might be interested in the market, that might be a stock trader, want to, get into the market, and help them get started on the right foot. Because this is how we're going to grow as investor base, and as our knowledge base grows, we're going to help each other out. And this is one of the ways that we do this. Now, of course, wrapping up, this stuff always works because option pricing is overpriced. And that's really the end result, is that options are always theoretically overpriced to what actually happens, which means that the value of these options is always inflated. And it's like insurance. We always want to sell insurance on something, and that's what you do when you sell options. So the key here is that when you give up some upside potential, you increase your probability of success and you reduce the cost of ownership. And that's all we're trying to do here, is leverage those few things that we can control to outperform the market with less volatility and less variance in our account balance. So I hope this has been a really cool episode today for you. We're going to get into the closing bell segment here and take a look at a new trade that we're entering in MON.
Now, the closing bell. Find out which stocks we're looking at right now, trades we're making, and hear our game plan moving forward.
All right, so in today's closing bell segment, we're going to look at a new trade in MON. And the reason that we're going to look at MON is because it has the highest implied volatility right now, and IV rank is around 72. So insanely high implied volatility, and right now the stock is trading about 105 or so is where the stock is trading. It just had a little bit of a dip kind of post earnings here, and implied volatility has actually stayed high, hasn't dropped off the shelf here. And so we're now beyond earnings, which is good. We don't have to worry about that, and we should see a continued drop in implied volatility in this stock going forward. So what we're going to do is we're going to actually trade a very tight and very narrow iron butterfly in MON. And we're actually going to try and position it a little bit bearish. Okay, so right now the stock is trading just below 105. We're going to go ahead and sell the 105 call options and sell the 100 put options. So that's going to be kind of our inside strike range. So the 105 calls and sell the 105 put options. That gives us our inside range. Again, a little bit of a bearish tilt because ideally we'd like the stock to be down around 103. And then what we're going to do is we're going to go out $20 on either end and buy cheap options further out. So the inside legs that we're selling, the 105 call and the 100 put, those are each trading for about $500. And then the outside legs for this iron condor, so $20 out up to the 125 calls and all the way down to the 180 puts, those are trading for about $64 on the call side and $40 on the put side. And what that does is that gives us a total credit of about $910 for each individual iron condor that we sell. So the difference between selling our inside legs and going $20 out and buying protection on this trade is net credit of $910. Now, with implied volatility this high, we could easily do the strangle or straddle, and that would be like the natural choice. But with the stock over $100, trading at just under 105, it's really capital intensive to go ahead and do this trade on a margin basis. So that's the reason why we're converting it from this really tight strangle or straddle to an iron condor, because we just want to conserve our capital. We don't want to use all of our capital in this trade and kind of carrying the margin that goes with it. Now, in this case, we're looking at the trade, again, could potentially make about $910. The risk that we could take on in this trade if it went completely against us, so further out than our 80 strike and our 125 strike, we could lose about $1,090. So it's very close to being a 1-to-1 risk-reward ratio. And this trade has about a 67-68% chance of success. Now, again, in my opinion, this is kind of the ultimate type of strategy or the ultimate way to trade where you have about a 1-to-1 risk-reward ratio or something very close to it, but your likelihood of success is dramatically high. And this is what options trading does. It allows you to make a strategy or build a strategy that does this around a particular stock price. So in this case, we're slightly bearish on MON, generally neutral on the overall direction. We've been through the earnings event, so we don't have to worry about that. The stock shouldn't move too much kind of because there's no earnings event unless there's any news that comes out in the interim between there. But now we're just going to play the volatility game and play the time decay game and hope we can take some money out of this trade sooner than later.
Thanks for listening to the Option Alpha podcast. If you liked what you heard, please drop by iTunes and leave a rating or comment. Plus, you can get everything: free email updates for future shows, transcripts, video tutorials, case studies, and more. Just visit our website at optionalpha.com.
All right, so I truly hope you enjoyed today's show. And again, it got at least one thing out of it that you can apply right now to make you a smarter, more profitable trader and investor. And please share this show and any of the additional resources and links that you'll find on optionalpha.com/show53 with just one person. That's all I'm asking. If everyone can share it with just one person that you know that would think would find value out of this episode that we did, learning how to generate more money than the market, had generate a better return with lower volatility, I would be extremely grateful. As always, you can head on over to iTunes and give us a review or a rating. It is the best way to get the show into the hands of those who need it most. and that would be extremely helpful as well in helping spread the word about what we're trying to do here at Option Alpha. Finally, you can get today's freebie, which is our ultimate strategy guide, completely revamped, expanded to 90 pages by going to optionalpha.com/ebook. Again, that's optionalpha.com/ebook. It tells you exactly how to enter each individual strategy, how far out to enter those strategies, when to exit those strategies, if you should use a stop loss. The whole thing is laid out for you in this ultimate strategy guide. Again, you can grab yours by going to optionalpha.com/ebook. Until next time, happy trading.